Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, December 20th, 2024. A week ago, and here I'll go back to my video update from a week ago, and let me just highlight this here. But a week ago I said it'll be interesting to see how it reacts, and by the it is Wall Street, reacts to next week's policy rate decision by the Fed. Right now, almost everyone is expecting a 1/4 percentage point reduction to the policy rate next week. Now, I further opined, if that happens, then I would expect Fed Chair Jerome Powell to make clear that the dot plot for 2025 and 2026 could end up looking quite different from what was anticipated a few months ago. That's exactly what happened. 2 days ago, the Federal Open Market Committee lowered its policy rate by 1/4 percentage point, but at the same time, the FOMC revised its dot plot for 2025 to include only 2 rate cuts, less than the 3 previously indicated. So if you ever wonder what a dot plot looks like, and this is a long document with a lot of economic data, but there it is. Each of these little blue circles represents one of the voting members of the FOMC. Now right here on the left is their votes for where they thought 2024 would end. Next column next to it's 2025, and of course they all don't agree. You can see there's one person up here on the high end near 4.5%, one person way down here near 3%. But the average, the median, appears to be right in here between 3 3/4 and 4%. Remember, right now we're at 4 1/4 and 4.5. So even if we do get those 2 rate cuts, for this dot plot to prove accurate, they would have to be basically a 1/4 point each, for a total of a 1/2 point. Now, even though that the scenario that I just described is what many analysts, including me, thought would happen, Wall Street reacted as if it was caught off guard. That day, the S&P 500 index fell nearly 3%, with all that decline occurring after the FOMC released its policy statement. Now, and look, here we are this week, 5 days, okay? Here's the S&P 500. As you can guess where this big drop-off is Wednesday, but here's the thing. Right there where I have the cursor, that's Wednesday at almost 2 o'clock, because the Fed releases the policy statement at 2 o'clock. And you'll notice that morning, if we go over here to 9:30, the S&P 500 was actually up slightly for the day prior to this statement coming out. And then look what happened. Boom. Big drop down, then of course a little bit of a bounce. And then even today, dropped, but then we got this morning's PPI report. So evidently the portfolio managers on Wall Street feel it is too soon to start easing up on rate cuts. And there was nothing in this morning's PPI report, or Producer Price Index, for November to refute that belief. Last month, the PPI for goods rose 0.4%, which is the red bar you see here. And the PPI for services increased by 0.2%, which is the blue bar beneath it. Now, combined, the PPI for all goods and services grew by 3.0% over the past year, which is exactly what most of the economists on Wall Street expected. Nevertheless, Wall Street reacted as if that news caught it by surprise too. Shortly after those numbers were released, and I'll go back here now to our chart of the S&P 500 this week, and here's today over here on the right. So shortly after that news was released, the S&P 500 went into rally mode and was up nearly 2% by noon, which is right about there, and you can see that's 12:20 p.m. And it's come down a little, but it's held on to most of that gain. We can only wonder how much higher it might have gone if the PPI numbers came in on the high side, which would have supported the argument for more rate cuts next year. And that's why I believe the initial reaction to Wednesday's FOMC decision was mostly driven by algorithms that value stocks based on the present value of future earnings. They were assuming a lower interest rate environment in 2025 and 26 than they are likely to get. When the FOMC revised its dot plot, those algorithms adjusted their discount rates for future earnings, and by that I mean lowered them, thus producing a lower present value for future earnings. However, machines are dumb. They can't think, which in this case could have avoided a lot of unnecessary volatility, in my opinion, this week. As I said last week, accommodative central bank monetary policy is a crutch to get through difficult times, which is why Wall Street would rather see corporate profits rising at a steady rate as the economy steadily expands. Now, Wall Street is getting the steadily growing economy it wants, but it doesn't seem to know what to do with it. Well, that's this week's PF video update. I look forward to talking to you another week. Between now and then, I hope all of you enjoy a very happy holiday season, whatever you celebrate or worship, or just want to take the week off to enjoy the upcoming new year. I hope you have a wonderful time, and we look forward to talking to you in another week. Thank you. Bye.